Hey everyone, so I recently purchased a brand new Dividend stock. This is a stock that I believe is a hidden gem in the sense that the large institutions, they have not found it yet. It's undiscovered in many ways because it's a smaller company, but I believe that this company is going to do very, very well over the long term. And I'm so excited to be building my position now before it becomes discovered. And so this company is called Utz Brands, Inc. They make potato chips and other salty snacks. And in fact, they are now the number 3 at-scale competitor in the salty snack food category. They are just behind PepsiCo, which I also own, and also Campbell's soup, which I also own. And so they're number 3. So I have the whole chip aisle now in my Dividend stock portfolio. And a lot of people, when I purchased this stock recently and announced it on Twitter and on my Facebook group, they were confused why I'm buying it because the price earnings ratio is very high. It is very, very high. And so I'm going to go into an extensive financial analysis in the video today that shares why the price earnings ratio on this particular stock is a little bit misleading. And the actual fundamentals, the financials behind the company, they are really, really solid, as is the rate of growth of this company. So before we get started today, remember to smash that like button and also check out the description in the pinned comment below, because my analysis that I share today, you can follow along at home for free. I have a link to my Excel file just below in the description and the pinned comment. If you enjoy those free Excel analyses that I share, please hit that like button and subscribe. I am so excited about the video today. Happy New Year. Let's get started. Welcome to PPC Ian. This is Dividend Stock Investing for everyone. So I couldn't really even believe that this company went public last year. It went public through a SPAC, a special purpose acquisition company. It went public with very little fanfare. And so I just found it recently, and I'm so excited about it. And I actually found this stock through some comments here on my channel and on Twitter. A few of my subscribers mentioned, what do you think about this? And when I looked into it, I was like, wow, I love this. And I'll tell you why I love it. They own the Tim's brand of potato chips as well. And Tim's makes those beautiful Hawaiian potato chips that are one of my favorite potato chips. But before I even dug into the fundamentals of this company, I wanted to do a little market research and understand their chips, because this is largely a regional player in the Pennsylvania area. Tim's is largely Pacific Northwest, but the original Utz brand is in Pennsylvania area. And so I purchased this variety pack. I actually went ahead and purchased the variety pack on Walmart, another stock that I own. And so when I went through the variety pack, there's all kinds of goodies in here. But the one that I like the best is the original, the Utz original potato chips. And this is very comparable, a very comparable product, if you will, to Lay's Classic. Although I would say Lay's Classic by Frito-Lay, which is owned by PepsiCo, has more salt. In this one, a little less salt, a little bit more of the potato chip flavor, the potato flavor. And so I also purchased these potato sticks just to try them out. We haven't tried these yet, and so we're still going through the variety pack and some of these products just to get a feel about what the company is all about. But I can say from my taste test, from my experience with the Hawaiian potato chips, from my taste test with the potato chips and their pretzels as well, the products are awesome. And so check it out on the screen right now. What I want to start with is just an overall market survey based on the recent investor presentation that Utz Brands shared. And what you can see here is number 1 is Pepsi, number 2 is Campbell's soup, but now they're number 3. And the reason they're number 3 is they recently acquired a company called Truco, which makes on the border chips. These are tortilla chips, and they also make salsa and queso. And so this is a really solid acquisition. I'm going to get more to it in a minute, but combining Utz with Truco, in my opinion, gives Utz the distribution that they need, to really go national, because this is largely an isolated geographic play so far. They're in the Pacific Northwest with Tim's, they're in Pennsylvania with Utz, but this brand has an opportunity to grow nationally now, especially through Truco, because Truco has the relationships with the big warehouse stores like Walmart. And so now they can leverage that for Utz, and also Utz can leverage their grocery channel for the On the Border brand of potato chips as well. And so I think it's a solid acquisition that's going to give this company some scale. I'm going to talk more about that later. But the reason I'm showing this slide right now is just, you've probably not even heard of this company, but they're number 3 in the category. And so that's what's so exciting about this thing is they're getting some scale. And so with that, I want to talk about my first 2 tranches of the company that I purchased that threw people in the community off so much. So check it out on the screen right now. And what you see is I purchased my first tranche at the end of last year on the 22nd of December, and my next tranche on the first trading day of the new year, which was January 4th, 21. And you can see I bought at $22.54 and $21.93. Dividend just over 1%, although there's a huge amount of room for that to grow over time. This is a yield on cost play for me. I'm not going to really value or benefit from the cash flow right now, but in the future, when they increase the dividend over the years, I will have substantial cash flow from this company, I believe. But what threw so many people off is the estimated 2020 earnings and the estimated 2021 earnings put the PE in basically the range of the 40s and 50s. And so investors are like, what, Ian? You're always talking about stocks here on your channel that you're buying for PEs in the teens. Why are you buying something with a PE of 40? And I will tell you off the bat that the PE here is throwing a lot of investors off. It is misleading them because this company has grown through acquisition. This company just went public through SPAC. There is a huge amount of depreciation and amortization, which is throwing off the GAAP EPS and inflating the PE ratio higher than it really is in a true sense. And so I want to go into an analysis today that explains exactly what's going on higher up in the funnel on an adjusted EBITDA basis. So check it out on the screen right now. And what you see is an income statement analysis that I prepared. This was based on the deck that was provided to me by this company. It's very new, this company. It's been public less than a year, although they've been in business for a very long time. This is an old family company that went public last year through SPAC and is growing very quickly now. So they have that heritage of being around forever and having a very loyal heritage with Tim's in the Pacific Northwest and in the Pennsylvania area with Utz. Very loyal customer base, but they're finally getting some scale now that they're public. But I use their deck, and again, there's only so many numbers even available on their website because they just went public. But basically what you see on the left is the 2020 year with Truco, and that 2020 year actually has 53 weeks. Campbell's Soup is on the right as a comparable. I own Campbell's Soup. I think it's a good comparable. I pulled Campbell's from 2019 annual report. The revenue that I back into is $1.15 billion for Utz. Now, that's on the lower end of the range. They give guidance here. They give a range. I'm going low end of the range because I do my analysis conservatively. Campbell's is at $8+ billion, but they have lines of business that are outside of salty snack foods. And so it's a more comprehensive business. This is a business just in the chip and salty snack arena. I pull the adjusted EBITDA, low end of the range for Utz with Truco, which is $184 million. And I pull Campbell's adjusted EBITDA. They provide EBIT, earnings before interest and taxes, but I had to add back in depreciation, amortization. I had to pull that separately, but basically the adjusted EBITDA for Campbell's is $1.425 billion. And so you get a sense of the scale of these two companies. Obviously, Utz is a much smaller company. That's why its market capitalization is $2.6 billion versus $14.7 billion for Campbell's. And so that's that. I pull in adjusted EBITDA margin, and this is earnings before interest, taxes, depreciation, amortization. And so it's a better look, if you will, of the core business before you throw in the interest, taxes, depreciation, amortization, which could really throw off numbers, especially the depreciation, amortization, because they're growing through so much acquisition. And I get an adjusted EBITDA margin of 16% with Utz. 18 with Campbell's. And so they're somewhat comparable in terms of margins, which is great because I would expect to see much better margins at Campbell's because it's a bigger company, more established. They have had more years to refine their margins, and they're operating at a much larger scale. So a smaller company, I would expect it to have poor margins that were much worse, and I'm not seeing that. They're somewhat comparable, a little bit worse, so it adds up. Let's keep going. What I see next is they provide CapEx and they provide adjusted EBITDA minus CapEx. And so capital expenditures at Utz are $28 million. $384 million at Campbell's. And so I get an adjusted EBITDA minus CapEx margin at Utz of 13.6% and 12.8% at Campbell's. So I actually get a better margin at Utz than I do at Campbell's, although I'll say that CapEx can fluctuate a lot each year, and so that adjusted EBITDA margin is more reliable as a comparison. And I just start looking, how are they trading on a PE multiple? Because I know the real PE for Utz brand, it doesn't make sense now because there's so much depreciation and amortization that it's just throwing the whole thing off. And so what I do is I take the current share price of Utz, I take the current share price of Campbell's, and then I divide by the adjusted EBITDA, and I divide by the adjusted EBITDA minus CapEx, and I look at those as multiples, and I want to see, how is Utz Brands trading as compared to Campbell's? Is it trading a lot more expensive? What's happening? And what you see on the screen right now is that Utz is trading at a market cap divided by adjusted EBITDA of 14. Campbell's is at a 10. Utz is trading at a market cap divided by adjusted EBITDA minus CapEx of 16.88. Campbell's is at a 14. And so you can see Utz is trading at a more expensive level than Campbell's on these multiples that I'm coming up with that I think are better multiples to look at than PE ratio here, because PE ratio doesn't make sense for Utz just yet. But obviously there is a pricing premium, and Utz stock, I'll share on the screen right now, it's run up. This is another critique I've gotten. Ian, why are you buying this thing? It's already run up so much. It's run up. It's trading at a high point. I hope it comes down a little bit. I'll buy more. I just basically drew a line in the sand and started with some small tranches. It's less than 1% of my portfolio. It'll probably stay less than 1% of my portfolio. It's a more speculative purchase, but every stock in my portfolio plays a role on the team, and this one plays the role of long-term yield on cost, on growth, on expansion, and that's what I'm looking for right now in 2021. And so with that, now that you've seen the multiples, what I want to do next is I want to share a growth profile. So check it out on the screen right now. This, again, came from the investor deck that was provided by Utz Brands. And what you can see is the Q3 financial results, that their sales year over year are up 24%. And what you can see here is their adjusted gross profit is up 34%. The adjusted EBITDA is up 39.8%. This company is growing really, really, really quickly, and it's not all acquisition, quite frankly. Some of it is organic as well. I'm going to get to that in a minute. But Campbell's Soup, by contrast, is basically low single-digit growth. So I get a company growing upwards of 20%, 30% versus low single-digit growth. But you look at the multiples that I just showed you, and I don't think the full growth rate of Utz is even priced in to the stock yet. And so I think it could trend up a lot more. And I think it has not trended up a lot more because no one's figured this thing out yet. It went public with very little fanfare. I don't think the institutions know about it. And I think the people looking at it are looking at the PE and flat out dismissing it because they're getting thrown off by the PE. And with that, check out the next slide. I want to share another slide from their investor deck. And what you see on the next slide is the growth rate bridge on sales. And what you see are really two big buckets, volume and acquisitions. So 9.7% of the growth is coming from volume, 15.9% from acquisitions. And so what I'm saying here is even without the acquisitions, they're growing organically. And I think it's all going to be intertwined because by doing the acquisitions, they're gaining more scale, they're gaining more distribution, there's more synergies. They're going to have a national footprint. They're going to have a footprint in more stores, not just convenience stores, not just grocery stores, but warehouses now like Walmart and they're going to get so much more expansion. They can bring all those Utz brands to Walmart through that Truco acquisition. And they keep making more acquisitions, and they're doing them at reasonable multiples as well. And so with that, I want to go back to the financial analysis. Check it out on the screen right now. And so I'll do a really quick balance sheet analysis. This one does not include Campbell's soup, but what I want to just quickly show is the balance sheet. And I also have an adjusted balance sheet because there's so much goodwill and intangibles because they're growing through acquisition. And most acquisitions are not being purchased at book value. They're being purchased above book value. And so this company has assets of $2 billion, has liabilities of $647 million. You got some good shareholders' equity there of $1.4 billion. But when you adjust for it, as you see on the right-hand side of the screen, what I do is I adjust goodwill and intangible assets down by half. I take them down 50%. When I look at it that way, I would say assets are more in the realm of $1.3 billion, and I would say liabilities are more in the realm of $647 million. The same, liabilities are unchanged. And so the true shareholders' equity, in my humble opinion, is closer to $654 million than it is to the $1.4 billion number. But still, I would say from my cursory analysis, the balance sheet for a company that is growing through acquisition at a time when interest rates are really low, I don't mind a company like this taking out debt, and quite frankly, the balance sheet, it looks all right to me. And so with that, I want to go into the next slide on the screen, which are just some thoughts I have had and some more information about this company. So check it out right now. And what you see on the screen right now is just kind of my thoughts about this thing. This is a regional gem in the Pennsylvania area, also Pacific Northwest, and it's going national and then it's going global. Easy expansion. For me, this is a moonshot. Anyone from Google who is watching the channel, who works at Google, will probably have heard this term. It means shooting for the moon, shooting for the stars, taking a little bit of risk. It's a moonshot for me. That being said, it's less than 1% of the portfolio. And so don't lose it on me here. I had people freaking out. Ian, what are you doing? You're buying a SPAC. You're taking on all this risk. All right, people, keep it in context. It's less than 1%. Let's keep going. And so I think it's a takeover target, although I hope not, because I think it'll grow quicker on its own. Their goal is to be the fastest growth engine in their entire space, and they're showing that so far. This is yield on cost play for me. Quite frankly, this is a year of expansion for me. Last year, with the pandemic, it was a year of hibernation. It was a year of focus. It was a year of focusing on the core, building core strength. This year, 2021, this is a year of looking outward. It's a year of expansion. It's a year of growth. And so I'm looking at companies right now like Utz Brand that can offer me a little bit more growth. That's just where I'm at. That's where my head's at this year. Let's keep going. And so I want to talk about the leadership. You can see on the screen right now that their CEO has been at the company since 1995. And I really respect that. And he's been CEO since 2012. And so I think with a company that's smaller, leadership is more important than at a company that is larger, where larger companies, maybe like a PepsiCo, honestly can run itself. But at a company like this, if we want it, really the thesis here is not steady Eddie. The thesis here is this thing has to grow, and it has to grow quickly. It's to keep growing quickly. And I want to compound 20+% revenue growth year on year for the next, say, 5 or 10 years. And if that can happen, I could have a stock on my hands here that could go up quite a bit in terms of capital appreciation and also dividend growth. Let's keep going. And so on the border acquisition, they paid $480 million for Truco. Now they're number 3 salty snack food platform. Only 14% of on the border sales are in the core geographies of Utz. So there's not much overlap between Truco and Utz, which makes them a great pair because there's going to be so many synergies between these two companies. And Truco now has the opportunity to expand into grocery, convenience, value, and drug, where Utz is really strong. And they show combined revenue estimate, which is very comparable to what I just showed in my own analysis. And here's where I pulled the adjusted EBITDA as well. I pulled the lower end of the range. We talked about the U.S. salty snack foods category. They're number 3. And we've talked about some of the numbers that you also see on the screen right now. With all of that, I want to close out with one more slide. Check it out. This is a slide from the company. And so what you see here is really their mission, what they're trying to do with their M&A strategy, with their value creation, they want to be the number 3 salty snack platform. And they want to scale into tortilla chips, salsa, and queso. They're going to expand their channel geographic presence. There's channel expansion opportunity. They have a strong financial profile. I've been reading Peter Lynch's book, One Up on Wall Street. I shared it in my last video. I'll link to it in the description below. Peter Lynch loves finding undiscovered stocks. I would look at this, obviously not just undiscovered stocks that have great products, but they also have to have great financials. And in the video today, I've shared why I believe that this company also has great financials to back up its undiscovered and great product status, which makes it a classic Peter Lynch style investment, in my humble opinion, and that's why I like Utz Brands in my personal dividend stock portfolio. If you like Utz Brands, or if you've ever tasted their product, ever tried it out, put your comments in the description or in the comments section below. I would love to hear what you have to say about Utz Brands, and also just share below what you're buying in 2021. I'd like to hear a little bit more about your strategy. This is a community here of dividend investors. We are dividend investing. This is dividend investing for everyone. And we all have different strategies, but we all tend to agree that dividends and cash flow are amazing. And so I'll have some really exciting videos for all of you this year. I am pumped about the new year. I am here to motivate. I am here to inspire. I am here to talk about dividends. Please subscribe. Please smash that like button. In all of this excitement for these snack foods, I almost forgot. Before I leave today, in terms of a full disclosure, I am long the stocks mentioned today. I own Utz Brands Inc., ticker symbol UTZ, PepsiCo, ticker symbol PEP, Campbell Soup, ticker symbol CPB, and also Walmart, ticker symbol WMT. I own all of those stocks in my personal dividend stock portfolio. Also, before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. I'm just sharing my personal journey here on YouTube for fun and entertainment, and investing in the stock market carries great risk. There is great risk of losing money. Before you go out and invest in the stock market, please do consult a licensed financial advisor first. Once again, everyone, I love you all. I wish you a happy, happy new year. It's 2021. I'll see you in the next video.